Hey, hi there. It's Neil Christensen with Aspire Mortgage Advisors. And, today I kind of wanted to go over what I think are the five biggest myths that one might come across when they're researching for a reverse mortgage. You've probably had people tell you when you've brought up the term reverse mortgage, oh, those are risky loans. They can be very confusing and frankly flat out dangerous. Well, I'm here today to tell you that that's not the case. And I hope that as you listen to these five myths on the reverse mortgage, it gives you better clarity so that when you get ready to get into retirement, or frankly even being in retirement, you'll have an understanding and maybe use this as a tool to make your retirement time even a better one. Myth number one: the bank is going to own my house if I do a reverse mortgage. Absolutely far from the truth. You, as the homeowner, you're still going to have title. Title is going to make you the owner, and you're able to sell at any point. As long as you keep it your primary residence and you continue to make payment on your property tax and your homeowner's insurance payment, and if there's any other type of maintenance like HOA dues, then the bank will never have the ability to come after you and take your house away. Myth number two is if I get into a reverse mortgage, I'm going to be leaving a ton of debt to my beneficiaries. Again, not true. A reverse mortgage is a non-recourse loan. So that means you're only responsible to pay back what the house is worth. So for example, if the house is worth more than what the debt is outstanding, then any of that difference, the equity difference, will go right to the beneficiaries when the house is sold. However, if the home value is upside down and the debt is more than what the house is worth, when you sell, you're only responsible to pay off what the house is worth. So that difference is going to be covered by the insurance that is part of the program. So the family is never responsible for any of the outstanding debt that might occur during the course of the loan. Myth number three is the reverse mortgage is really only there for desperate people. That's not true either. There is a needs-based part of the reverse mortgage, those that really need to not have to make a mortgage payment. But I see it more as a financial planning tool. And what I mean by that is it allows one to take tax-free cash from the line of credit, which is part of the reverse mortgage. And an example would that be one to delay their Social Security payout. We all know that if you delay your Social Security, you're going to get more later in life than you were sooner or earlier in life. And that would be a strategy to consider if there were other reliable source of income funds to satisfy your livelihood at a younger age. Or if the stock market has gone down and rather than pulling from a market that your assets are lower, utilize your reverse mortgage until the correction was to go back up for the stock market, and then you can go back pulling some funds. And then ultimately, it's just more of a flexibility type program than just your standard type conventional loan that most people have during either their working years or during retirement. Myth number four is it's easy for me to lose my house in a reverse mortgage. Again, not the case because the government has made it a very protected type loan for the consumer. As a matter of fact, you have to go through a counseling session before you actually even start the process of going through and getting the mortgage. The counseling session goes over the pros and cons of the product just so that you're very aware of what you may get yourself into. But after that, if you still feel comfortable, then the process to go through the loan would start. And then last is they're super confusing. They've got this line of credit and there's deferred interest and stuff. It's really not the case. The mortgage statement that one receives on a monthly basis is extremely simple to understand. Basically just says, here's your outstanding debt, just like you would see if you were looking at a regular loan, knowing that that's how much I need to pay off when I sell the house. Or if the house is less than what the debt is, well, that's why I have the insurance. So it's not that confusing once you start to understand the mortgage statement that you receive. After a couple months, you'll have it down pat. So there you have it. The five myths of a reverse mortgage debunked. So if you'd like to have a conversation to talk a little bit more about this specific to your situation, let's sit down and talk strategy. I look forward to hearing from you guys. And in the meantime, keep having a great day. Look forward to speaking to you soon. Take care.